There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians, traders of the world, to the Saturday shortened podcast, video cast, a general cast from yours truly. My name is Steve Vetterl. I try and act in a macro teaching, trading mentor. Oh no, not that much lately. Analyst, market tactician, there's our word of the day, right? And all around risk management dude. So the last week in general, and many people know that I speak mostly from the standpoint of the markets in general, right? Obviously, equities take front and center stage, at least in my opinion, and everything else, with the exception of the Forex markets, is somewhat of a pin action off of that and all the other things that happen, right? So generally, I noticed in a lot of the forums, which by the way are shifting from Telegram over to Discord, I would imagine at some point, I logged in about a week ago, I didn't see anything for Market Watch, the Tuesday and Saturday casts I do. Tuesdays are right around 1 p.m. Eastern. Saturdays typically a little bit after 10 a.m. I didn't see anything. That's not like, I don't think they've built a page for it or some sort of like chat related to Market Watch. Honestly, I don't know that I'd monitor it. So oftentimes in the weekend, I'm broadcasting from my home office instead of the office during the week. So I have less screens to be able to monitor different stuff while I'm upcasting. But in any case, as always, the August 9th presentation I did last Tuesday brought in a couple of new tools and sort of the thought and analysis process. To go ahead and check that out as well. I'm going to start off with just we'll go through the Forex Factory as well. Actually, let me just switch to tomorrow before I forget. Let's get rid of the news stories that don't matter in my opinion. There we go. So Monday the 15th, summer is coming to an end. It's kind of a bummer. Just depending on where you live in the world. So we have holidays tomorrow. I would say enough of a holiday that things could be quieter. That doesn't mean they will, right? What if I'm wrong? Remember, I always joke about that. I had a client say to me the other day, he's like, Steve, I watched a couple of your casts and you always talk about being wrong. Yep. And because I am wrong occasionally, sometimes I'm wrong frequently. So you just have to do your own research. And quite frankly, if everybody's nervous that I may be wrong, what behavior does that force? Think about it. The behavior that forces is one building their own fishing boat, right? We have a lot of advisors that want to partner up with First Down, our IMO and RIA in Florida. And, many of them using Gmail accounts, right? And a lot of them they're not technologically savvy. They don't necessarily need to be, but for gosh sakes, you're dealing with people's money. The least you could do is have a professional look, right? Don't have a Gmail account, have a professional email, right? Like Steve at firstdownfinancial.com, right? Or something like that. So The same thing can be said for trading. And as I sort of go through the morning diatribe here and occasional ramblings, I have been asked by Auvoria to shoot 2 videos, which I'll do from my new half-ass studio in the office, which should be kind of fun. But I'm going to shoot a short one. I just have to find out how long they want me to ramble on for. I have to shoot 2 of them. One of them's why you should not trade, right? And why of them is you should trade, right? But at the end of the day, the difference between the two is it all depends upon one's motivation, right? You don't have to reinvent the wheel. As I often use F1 references, look what teams are winning, right? Team Ferrari's winning more this year. Team Mercedes has won a chunk of the entire last decade, right? So you want to look to see what those teams are doing well. I mean, they have tire specialists, right? They have chassis specialists. They obviously have engines that come from a couple of centralized points, but they're all super specialists there, right? So, each person in the team has, some of these race teams are ridiculous. I mean, some of these Formula One teams cost $1 million a year to make the trek around, 15 plus tracks globally, right? It's very costly. Some of the most costly in the world of anything in terms of sports. And, they're prepared. Now you're one person, so well, how can I run a whole race team if it's just me? You don't necessarily have to, but just find the tools to put in place to be that good trader, right? Understand how Forex Factory works, right? Maybe as an ancillary news source, understand how between the hedges work. In many cases with headlines, and it's mostly just a exercise in sifting through what I call crap, because most of this stuff's just a pile of shit, right? And you want to be able to get through this, and most of it just doesn't matter, right? But what I do is I scan through, in this case, Bloomberg. I start with Bloomberg, and it just goes all the way down through Fox News and CNBC, Zero Hedge. Right? Just keep in mind, anything that's Zero Hedge is a bit fringe. Sometimes they break some stuff, right? MarketWatch, these guys are generally knuckleheads, but it's coming from all of the different news sources out there. The Gateway Pundit, Politics, right? Epic Times. You can rip through this and I don't know, maybe in 5 minutes gauge what potential change in sentiment is shifting, right? You're always looking for max pain in the marketplace, I talk about. So in order for one to get a whiff of where max pain lies, you have to sift through the headlines. So I'm not going to go through each one of these, but I just want you guys to understand, just from a macro perspective, what's going on. So the prevailing winds, if you were in a coma and just woke up, or you just climbed out from underneath a rock, I'd say welcome to the world. Lots of terrible stuff going on simultaneously. The current prevailing winds are that of a Fed pivot, right? If the prevailing winds weren't of a Fed pivot, would the equity markets have rallied so much off of the lows of June? So just to put this in perspective, actually, let me make this bigger. And a lot of times it probably seems like, well, hey, this is always an equities discussion. Well, it kind of is, because everything else can be pin action off of it, because outside of Forex and credit, some of the most heavily examined markets on the planet. The sentiment, typically in the form of price action, can lead us to lots of different theories, in some cases an actual thesis we can put together that'll play on to any market, right? So as we decidedly, this was an area right here where you had a lot of bearish folks and a lot of bullish folks that are currently bearish, all trying to load the boat short. And I said very frankly, do not be doing that right now. Okay. Why? Because just the concept of just looking at this chart, and we'll jump over, maybe it's probably better to show in an S&P chart here. So the concept of max pain is one of just understanding where most of the participants in the marketplace are going to be loaded in one boat, right? Boat starts to tip. In many cases, it'll level itself out, right? A lot were going short here, I saw, as we broke above really, really tough resistance lines, although we seem to have what's called a one time framed higher out of it, right? So here's a 1 day time framing today, I should say from the 9th of August to 10th of August, arguably the 11th. These are all one time framing days up, meaning that even though everything said load the boat short, other time frame players are stepping in to take the markets higher in this case. The question really is are they right? Right? But the concept of max pain dictates don't pay attention to the areas of congestion, right? In anything. I don't care if it's fibs, moving averages, and some sort of amalgamation of Keltner channels or Bollinger Bands. Look for pockets of what could happen that nobody's thinking about, right? That is sort of the beginnings, if you will, novel one or module one of the max pain theory I talk a lot about, but understanding how max pain works in any market, right? Not just equities, you can apply it to Forex, gives you the insight to be able to what's called envision what can happen, right? This is, in my opinion, when a intermediate or advanced trader really begins to move into true expert level, is when they can see something, in this particular case, a huge congestion, right? And a lot would say, well, we look at what happened here. We had we had a rally up into it and it totally failed here. This was an island reversal, right? Arguably, you could kind of say that. It's sort of a sloppy one, but whatever. It opens up way outside and then it reverses back inside. Arguably, a more powerful hammer reversal would be if it actually finished under the previous day in what's called an engulfer. So an engulfer is typically very bearish, but this had a lot of people on edge, like, hey, all right, let's load the boat. We want to go short. I say, no. You're waiting a little bit more, right? And what happened? Something came out. In this case, it was CPI. It was a lot less, even though it's a terrible reading year over year. The market saw it month over month, right? So it went out and just caught everybody flat-footed. Now we are approaching very fast an area of max pain, okay? So inverse head and shoulders broke neckline right here. So 10 patterns right here, right? Including the bottom of the level of notched area, right? It's almost a 50% retrace of this little congested sideways trade here up in these little pockets. But the market essentially is auctioning higher because other time frame players are they're not hitting the bid, they're lifting any offer, and they're pulling the markets up into this area. So as we begin to, and this is where honestly a lot of funds out there that got a pretty decent level of leverage. I mean, these guys are just getting barbecued on these short positions and margins. The bat phone, as I joke in the back room, is ringing off the hook, right? You either start liquidating the positions that are over leveraged, or New York's going to do it for you. Okay. So, and I actually just saw a movie last week for those that just want to do a little deeper dive on that called Margin Call. It took a look at the financial crisis from the perspective of insiders at Goldman and Lehman, and to a lesser degree Bear Stearns. Stuff they did to throw crap, if you will, on the rest of the market, while the rest of the market didn't realize that most of these tranches were full of CDSs, right? Credit default swaps and pools thereof that were junk. So the market perceptive of that was, hey, they're just selling at fire sale prices because they want to get rid of a bunch of stuff. Meanwhile, they didn't lift the wool off of the situation and see that there was a significant problems to the underlying tranches, right? It was the core fundamental problem of the 2008 financial crisis. So again, so just moving above this area, this is actually almost a place where come Monday or Tuesday, depending upon how the narrative may change to the Fed raising more, right, versus the market, which could be incorrect, thinking the Fed's not going to raise interest rates much more, and that's why these rip-roaring rallies have come. I mean, heck, we were down the worst on the S&P 22, was it 20? Actually, it's 24 and a half, is it right? 24.5, 20, almost 25%. Now the market's only off less than 10. So that's how much equities have rallied. So if you are someone out there that has been over leveraged in equities, you want to lighten up the portfolio, you are being given an absolute gift window right now. Okay. Especially if you have a short time frame for the money and you were getting hammered in your 401k or whatever accounts. So now, does that mean, oh, well, Steve's telling us to lighten up on equities in our accounts? That means the markets are going back down? No. All I'm saying is that Max Payne dictates what? That the markets try and head in a direction that nobody would have thought about, right? This has happened time and time again throughout the decades where Max Payne gets hit in any market, right? And you have most of the people on, most of the idiot pundits on, like Bloomberg's an example, are flabbergasted. They're like, I can't believe the markets are going up this much. In the face of a recession or in the face of, blistering inflation. Well, markets are an advanced pricing mechanism, right? They will trade based upon the future, not current, right? Now, markets not always that efficient, but just generally domestic developed equity markets do act in, I use the S&P always in these examples, but they act in that capacity. So there is my macro lesson for the weekend. Let's go back through. I always say these are going to be short broadcasts and I get on a rant, huh? One thing to note about the IRS, it makes for great headlines. It scares clients. And honestly, if the long arm of the law, the government can come in and sift around in your life to a larger degree, that has a anti-capitalistic, anti-democracy tone to it, right? But just understand this, and I trust me, this comes from absolute firsthand experience with a number of employees at the IRS. The place is an absolute mess. And I don't know that 89,000 people are going to be able to straighten the level of mess out. Now, I would venture a guess to say that, one, they won't have anywhere near that hired because it is a difficult position. Two, there will be massive attrition on the other side. Almost like another 89,000 will decide to retire because they're pissed off because they're bringing in new ones. Steve, how do you know all this? Trust me, I know. I've talked to these people. I know what the sentiment is internally. So it's almost like it doesn't matter. I know that sounds like completely opposite. For all of those that are out there, I'm betting on the mess not writing itself. That's all I'm going to say on that. So that'll cool that one down. So, but the concern from the equity market's perspective is that I think the equity market's perspective from like a taxation standpoint is that the Build Back Worse bill, they should call it the Build Back Crap bill because it's just full of pork and craziness and green initiatives that are terrible for the economy, will do absolutely no good to building a stronger democracy or a capitalistic based economy, are going to be, one thing that it does tell you is there's going to be more taxes, right? And I think the taxes are going to affect every asset class with the exception of the poor. So that we can pretty much bank on, but that really comes as no surprise to any educated tax-paying American, right? They knew with a 33 trillion plus level of debt that at some point the piper is going to come a calling, right? The tax man's going to come for a larger chunk of the wallet to fix those problems. But the key also is that going through a lot of these news stories, at least from just a broad perspective, don't get too caught up in this stuff, right? Just use it as almost like a speed reading thing on what's going on, taking, just some news outlets carry more weight than others. Some news outlets are totally pushing a narrative one way or the other, right? Know that before you go through this. Just understand that all news outlets globally, they make money off of you buying or watching or viewing, right? Or participating in their news events in some form. The mania that is created by a typical headline is something that is just a core to journalism, right? Create the mania and they will come and click, right? Or they will come and view. The higher click view rates and all of that are, the more advertising dollars that can be charged to, I guess, the end client, right? So, it's almost like I'm saying, well, all news outlets stink. Well, yeah, they kind of do, because they are pushing mania, right? Mania is detrimental to somebody's ability to see the forest through the trees, right? So I would say just take it with a grain of salt, just to sort of glaze through it. So let's take a closer look at Forex Factory. CPI, this will be important right here. Keep an eye on this one. Into next week, find out what the other side of North America is doing, right? Heck, for that matter, you're going to want to take a look at all these CPIs next week. These carry the biggest weight, right? Unemployment's always important. Certainly our Fed minutes and Fed meetings obviously take top of the food chain, if you will, of news. But everything's CPI right now. So it's either geopolitical events, juxtapositioning between China, Russia, and Ukraine, or stuff that is related to, and in the case, there's subsectors of that, like the almost energy crisis that's going on in Europe. So know what's going on big picture, take a deeper dive, know what's handling the markets. It's enough on the S&P. Let's take a look at the DXY. As I said, I thought continued levels above or in the 105 area to do more work sideways. We're up in new territory. We've blazed a new trail. Time has to be spent up in this area, auctioning back and forth in order for price discovery to continue to play out. That's what's happening right here. What else? I'm not going to spend too much time in this area. Do want to show a few. Gold. Back up inside that area now. We're continuing to trend sideways, maybe needing more time to build sideways. Nice little rally off the bottom. Pound. Now, we're looking at a daily chart. It's the first time in a while that, again, the pound has continued to break down, at least against one of the Aussie countries, right? I'm just ripping through these. These are daily charts. Pound yen sideways. Pound franc, new low, by the way. Remember, pin action can pull from one to the other, right? Pound not necessarily in that last chart, but pound can be much weaker than all of the majors, maybe not necessarily in relation to the US dollar, but it can push the pin action of further weakness in all currencies that are not already weak, right? Euro GBP, though, interestingly, no new lows. Euro yen, CAD, franc, Aussie US dollar. Now, interesting here. Look at this. Up against, for the first time in quite a while, since the beginning of June, a rally that probably took out that max pain trade that I was talking about, right? Ripped up into an area nobody thought was going to happen. Probably lifted up this squeeze zone support area as well. Maybe that'll stall out here. Maybe we'll continue higher. But I could tell you right in here is where max pain for this is. Why? Because nobody's expecting it to go to that area, and it could. Doesn't mean it will. All right. Yen. US CAD. All right, so not making new lows in relation to the dollar. It's probably just because of the weakness of the dollar across many majors. So here is Euro US dollar. Wanted to show this as well. So we're still in the rangy of almost should be a squeeze zone line right here, by the way. 1.036 on the high. Bottom of the zone, in my opinion. Almost par. By the way, this is like a perfect touch of par. Isn't that funny? Is that like a Grateful Dead song, Touch of Grey? So, should take a picture of this at some point. If you're going to buy stuff with US dollars in Europe and you're wondering why it still is much higher, they like haven't done the currency conversions recently. You're still getting jacked. It'd be a cool picture around par. They get the line perfectly on. Oh, look at that! Look at that! Oh yeah! Oh, I blew it. Oh, jeez. There we go. Perfectly at par. Look at that. One. Steve, why does this matter? Who cares? Yeah, it really doesn't. It's just ramblings of an old man. So, let's take a look at the Ripto in crypto. Although I really wouldn't say it's any kind of Ripto. So, very defined, tight areas of. I tell you, looking at this chart, problem is that this just does not trade conventionally with conventional wisdom, like other developed and aggregated markets trade outside of Forex. But if this was the type of market where I was comfortable that data was solid and aggregated and of a quality nature, and they acted like other markets, kind of, I would say that max pain for this trade is probably somewhere right in this area. Right around 30,000 a coin. Ripping up into this area, just a pronounced rip. Probably have, I should say, will probably contain this trade sideways at this level. Somewhere around the 31 to 32,000 a coin area would be my hunch based on price action. Nobody's expecting it to rip up, right? Hence max pain. Many are expecting that eventual meltdown back down to some other area. I would say that, and that may seem conflicting because that's not the prognostications that if you spend a lot of time in crypto land that you're getting. But keep in mind, I always extrapolate out the group of idiots. This would be anybody that is not an expert technical analyst, in my opinion. All right. So I just weeded out like 99% of the crypto nutcases that are out there with, I don't care if they have 1 million followers on YouTube. Right. There's probably a few that are really good at technical analysis. So, and just understanding how this very, very different type of asset class trades. Those are the ones you want to pay attention to. Problem is weeding through all the nutcases to try and find that group, right? It's a tough thing to do, especially on Twitter. I always say pay attention to the people that follow them, right? big people, people like, I don't know, the 9 or 10 hedge fund guys I follow on Twitter, right? Vast majority of that group, not necessarily talking up their book, which would be detrimental, obviously, in which case I wouldn't pay attention to them. But they are very educational in nature. I think they genuinely want to help, at least from a Twitter perspective, in their profile and perception, even though they may be trying to blast you investment-wise on the back end, of taking the opposite sides of the trade. At least they put out some education on the front side to help you in your path to consistent profitability, as I used to say. What else? Celsius kicking my ass. I hate it when the train left the station and I'm not on board. Feeling quite boneheadish with that trade. What else? Take a look at TBT, have we? Let's go back and look at that. Let's take a look at TLT first. So this is the 20-year. As much as see it's a daily chart, we've been trading sideways. But if we went over and looked at the credit markets, I think we did today, you could see they have jumped up in price from the middle of June, thinking the same thing. Hey, Fed's done, right? And obviously, they're probably pulling back a little because they've made such a marked move depending on the note or the bond. Some pretty big moves just in 2 months, right? It's almost a perfect 2 months since the bottom. We've ripped up in what used to be uncorrelated markets. Equities have been perfectly correlated this year. So as bonds have gone up, so have equities. They've traded in tandem. Yen. Kind of looking at his NDZ chart. I don't even know if this is correct data, huh? This probably blew out a few accounts right here. It's a great example why you just want to. I don't consider this a major, even though many do. It's still the Wild West, in my opinion. So, if you notice, they made some shifts in currencies in terms of how they view them on FinViz here. But we're still trading sideways on the euro, obviously, because of the fact the dollar is digesting this ridiculous move up. The less of all evils, as I say. Well, why the dollar rally so much if the country's so in debt? Well, it's the best of all evils at this point. At least that's how the marketplace has perceived it. At least it was up until the middle of July. Now they are perceiving it as not the best of all evils. Hence the price is going down. So, all right, cool. So we'll just leave it at that. So hedgefund.blogspot.com is the new news source. We'll be using that going forward. I'll make more references to different ways you can dice it up for your macro analysis. Wish everybody a great trading week. Always stay clear of the craziness. Don't fall down the path of bad and persuasive narratives. If you think they're on the fringe on any side, ignore it. Go out and give your loved ones a hug. Steve Vetterl, off the mic.